What's up, y'all? What's up? Welcome back to another video with your boy Millionaire Abe. Once again, I told y'all this is, I believe, if I'm not mistaken, it is currently, let me make sure, because the last video I low-key messed up a little bit, but I want to make sure I don't. So this is episode 4 of the series. We're going to be going over risk management, and I'm not going to talk for too much long, but let's go straight into the video. Let's get it. Alright. So for proper risk management, this probably would be, it doesn't matter how good your technical analysis is in trading, it doesn't matter how good your fundamentals are in trading. If you do not have proper risk management, great risk management when you're trading, it can ultimately lead to the downfall of your trading journey, and obviously it'll lead to you blowing thousands and thousands of accounts. There used to be a lot of times when I traded in the beginning when I first started, excuse me, I used to try to pop like $1 lot size on a $100 account and think I was gonna get rich overnight. And I woke up the next morning and what happened? The account is blown. Like, what did I expect? So to prevent that from happening to y'all, for those that know what I'm talking about, then you know what I'm talking about. But for those that don't, if you're new and you're just getting the Forex sauce for the first time, just getting a better understanding of it, today I'm gonna break down like the proper lot sizes that you should use based off of my own personal experience, like how I like to trade. And hopefully this works for you. And let me stop talking and actually get to typing. So let me go ahead and title it Proper Risk Management Video. Bet. I can't spell risk. Wow. Now I know everybody got their own different version of how they choose to trade, like the lot size they choose to use. So this is completely biased to how I like to trade it. If you trade yours a certain way, good for you. The proper lot size you use for yours might be different from mine. Cool. But for me personally, I'm gonna start off like this. So how I trade is basically for every 0.01 lot size that I use, I need to have at least $10 in my account. So if you're somebody wondering, hey, can I trade with just a little amount of money? Yes, you can, but don't expect that you're gonna get rich, or don't expect that you're gonna make a lot of money in the first couple weeks, couple months trading, because if you're using $10, $20, $30 to fund your account, you're most likely gonna see yourself potentially struggling a little bit, right? And that's gonna come from trades that you're gonna have success on, trades that you're gonna lose on, just like the simple fact that you're not using like a high enough lot size to make more money. Obviously they say scared money don't make no money. So if you don't invest a decent amount of money, I recommend anywhere between $150 to $300 to start off with when you're trading. If you want to put more in, cool, kudos to you, that's you. But I recommend for all my new members that join my group, anywhere between $150 to $300 is a good threshold to start with when you're funding your account. So how I do this is basically, so for every $10 in my account, I can trade, excuse me, up to a 0.01. So a 0.01 per $10. If I have $20 in my account, that means all you would do is just add an extra 0.01. So instead of 0.01, I can trade a 0.02. So 0.02 per $20. And then as you can see, like, I'm just going up. What is happening right now? As you can see, I'm just going up by 10 cents every single time, or by 1 cent every single time. So if I got $30 in my account, 0.03. 0.03 per $30. If I have $40 in my account, you could trade it to a 0.04. And all this is doing is making sure, like, this is just making sure that you're not over leveraging. You're not, with these lot sizes, it's gonna guarantee that you, I ain't gonna say guarantee, but it's gonna give you a better, high probability of not you losing all of your money when you first start trading. So with $10 in my account, I know I can't, this is honestly the lowest lot size that you could trade anyway. So you can only trade a 0.01, and basically a 0.01 is basically saying that the market is going to move only 10 cents per pip. So anytime the market moves up or down, if it catch 10 pips, that means I'm going to make $1. If it catch 20 pips, that means I'm only going to make $2, and so on and so on. Versus someone that might trade, I'm going to go to it, let me keep typing. Versus somebody that might trade a 0.05, a 0.05 if they have 0.05 on every trade and they catch 10 pips, they're making $5 per trade. And then they're catching 20 pips, they're making $10 per trade. And that's why you start noticing, like, okay, the importance of lot size. And then once you figure out basically like the overall objective of when you actually, like, what's a comfortable amount of money for you that you want to actually risk, and how much you want to make per move. I know people that want to make $20 per trade. They're like, cool, I can get a bag of chips, some Chick-fil-A with that, whatever I want. I know people that want to make $100 per trade because they have bigger goals, they have bills to pay, they don't have time to like play around with the market. They actually want to use it to help pay for stuff, right? It's totally up to you. Don't mind me, I'm just still typing this out. Honestly, I could have did this in the beginning of the video, but it's cool. So 80, and then hopefully by now you're kind of like seeing what I'm doing. Every time you up $10, once you get from 10 to 20, okay, you can use 2 cents, $30, 3 cents, 4 cents, 5, 6, 7, 8 cents, 9 cents. Ultimately, you want to get to at minimum 10 cents. And I'm gonna stop right here because this is like, for me, this is like when my trading started changing. And I say that because once you start trading with a 10 cent lot size, that's when you're starting to see those $50 days in the market, those $100 days in the market off of just 1 or 2 trades. So like I said before, so when you have 1 cent in your account, when you're trading a 0.01, you can only, a 0.01 in the market is only moving 10 cents per pip. A 0.02 is only moving 20 cents per pip. A 0.03, 30 cents per pip, and so on and so on. Until you get to that 0.10, now you're moving, anywhere the market move is going up 10 pips, I'm making $1 per pip. So if I catch 10 pips, I'm making $10. If I catch 20 pips, I'm making $20. If I catch 50 pips, I'm making 50. If I'm catching 100 pips on the trade, shout out for those that trade SPS with me, you're gonna make $100. No, if you're catching 100 pips on the trade, you're gonna make, I was right, you're gonna make $100 on the trade, right? And that's why I said, like, at some point you want to be able to get to this at minimum, because this is when you're gonna start seeing those results that you want in the market. You're gonna start seeing the success. Let me see. I don't really use this on here. You're gonna start seeing those like pip goals, those pip goals, money goals, whether it's $100 a day, $200 a day, $300 a day. You have to at least start. Really, you gotta start here and grow your account up, depending on wherever you start your account at. But 2, you have to at least start off with that 0.10 at minimum to get your feet wet. Because a lot of people might make a mistake and they might think, hey, oh, $1 a lot isn't nothing. And that's the reason why I'm about to go. That's the reason why I'm breaking down the lot size right now. So a lot of y'all gonna come in here, if you're new, you're gonna come in thinking, oh, $1 a lot is only, I'm risking only $1 per trade. $1 isn't nothing. I risk $1 per trade if you go up or down. That's not what that is. If I just told you 10 cent, a 0.10 cent lot size is $1 per pip. $1 lot size is $10 per pip. So you're not risking, if you risk 30 pips on the trade, you're not risking $30 like you would over here in 10 cent now. You're gonna be risking, if you risk 30 pips on $1 lot size, you're risking $300. If you're trying to make 20 pips, if you're trying to catch 20 pips on a trade, you're gonna make $200. You're gonna make $300, $400, $500, $600, $700, $800, $900, $1,000 just off of simply using that dollar lot size. Because understand, a dollar lot size is moving $10 per pip. This is moving $10 per pip. That's the big boy account. I highly recommend that you have at least over $1,000 in your account before you start popping a dollar lot size. So that way you can use proper risk management. You're not over leveraging. You're not sweating bullets if that trade starts to pull back, because you know you have a decent amount of money in your trading account, in your bank account, to make sure that you're comfortable when you're trading. You always, basically, like, that's the main thing like this video is about. Like, you want to make sure when you're trading you're comfortable, because if you're not comfortable, that means you're uncomfortable. And if you're uncomfortable while you're trading, that means you're stressing. That means you're gonna be looking to get in and out. You're gonna be basically like paranoid. You're gonna be constantly checking your phone and basically freak yourself out, and ultimately lead to you blowing your account, or lead to you just closing out a trade instead of trusting your analysis or trusting that trade that you might get for somebody else. So this is just the basic of it. I'm gonna go I'm gonna dig it a bit deeper right? So let's say, for example, let's see, what's a good example? Let's say we're gonna use a 0.10 lot size. If I have $100 in my account, I know with $100 in my account, I can trade up to a 0.10. So even though I've been telling you guys how much you could trade up to, so these are the lot sizes that you could trade when you have this amount of money. So even though I can trade up to a 0.10 in my account, you don't necessarily have to trade that 0.10 on every single trade. Why? Because if you trade, let's say you pop, I hopped in 2 trades. Somebody sent out 2 trade alerts. You hop in the trade right here. You hop in one trade idea number 1. Trade idea number 1. You pop that trade with a 0.10, and somebody sent out another trade. You're like, okay, cool. Trade idea number 2. And you pop another trade for a 0.10. Right? That is a big no-no. That's a big no-no. It's a big no-no because, yes, I told you when you had $100 in your account, you could trade a 0.10. But when you place 2 different trades for a 0.10, this is no longer a 0.10 lot size. Just like in math, when you add 0.10 plus 0.10, this trade now becomes a 0.20. So now instead of you risking just a 0.10 on that first trade idea, when you hop in that second trade idea, you're currently risking 0.20 lot size. So in order to make sure that don't happen, to make sure that you're not considered over leveraging in the market, and you know when you're over leveraging, for those that use MetaTrader 4, your screen will start going red, your margin level percentage should probably be below 100, and ultimately you will start seeing like your account like go bloody red. It's gonna, everything on your chart is going red, and you're gonna end up paying stop loss, or you're gonna end up getting kicked out of the trade by the broker, and the broker is gonna make their money and you're gonna be sick, right? So to avoid all that from happening, make sure you're paying attention. Make sure you're using a proper lot size. So let's say I called out of trade, right? I call out one trade. You're like, you know what, Abe? I don't want to go all in. I don't want to. In stocks, they talk about, oh, going all in on one stock. You know, you want to spread out your money on different stocks, right? Same principle applies here. On Forex, you don't want to over leverage right away on one trade unless you're looking to swing trade. But I'm gonna go over that in a later video outside of the course. But so if you're someone that's looking to hop in the trade, you know somebody may be calling 2-3 more trades later on today. Let's say for the sake of this example, let's say I want to hop in only 2 trades. So just like I told y'all, a 0.10 plus a 0.10 equals a 0.20. The most I want to trade on my first trade idea is a 0.05. Why? Because I understand, like, hey, I could trade up to a 0.10, but I'm only going to trade at 0.05 just in case I want to hop into another trade. So if I hop in another trade, which will be trade idea number 2 again, I know I can pop another 0.05 on this trade. And now I'm not over leveraging. I'm using great risk management. I could trade up to a 0.10. Between a 0.05 plus a 0.05 totals out and equals a 0.10 lot size, right? So right now I'm doing great risk management. I'm not risking that much per trade. And you could take this same principle to, let's say you were looking for a pullback in the market. And let me see, bring out the drawing tool for y'all. So let's say you hop in the trade. Can I make this a straight line? Let me see. Let's say you hop in the trade right here with our horizontal line. This is your entry, right? So this is trade idea number 1. You hop in that first trade for a 0.05. Cool. The market taking off for your buy. You're doing great. You're up like $10, $15. Out of nowhere, the market is like, hey, I want to pull back and test that entry. No, I don't even want to pull back to test that entry. I want to pull back to like right here, right? But you know overall, the overall trend is what? The overall trend is in the uptrend. And you're like, oh snap, it's pulling back. What should I do? If I enter that first trade for a 0.05 and I see that the market is pulling back, cool. That second trade idea, I can pop that same 0.05. I'm just going to catch I'm going to catch my second entry and I'm going to ride it out to whatever TP that you choose to desire, or whatever TP that your mentor or whoever you are using to trade with guide you. So your first entry is right here. My fault. Your second entry will be right here. So entry number 1. Entry 1, I'm only using a 0.05. Let me bring this closer and spread that out so you don't get confused. So this is entry 1, a 0.05. It's not a way for me to bring the font down. It's cool, whatever. So that's entry 1, 0.05. Entry 2 is your second entry with a 0.05. And I'm using great risk management because I have $100 in my account, and I'm not going to be over leveraging because I'm trading my proper lot size of a 0.10, right? And let's say TP is 30 pips, 40 pips. If TP is 30 pips, that first entry you're going to catch 30 pips, you're going to make $15. Off that second entry, if you still set it for 30 pips, maybe that's halfway, you're going to catch, like, let's say that second entry is like 20 pips away from your TP. And then from there, you're going to catch $10. So 10 plus the 15, you just made 25 bucks off of entry 1 and entry 2 without even over leveraging, right? So with that being said, I hope this video helped y'all out a lot. Trying to think before I close it out, is there anything else I'm missing or thinking about? I went over pullbacks, I went over breaking up the trades. Yep, so yeah, so for the most part, I think everything's cool. So if you have any other questions, just comment below in the video and I'll make sure I get back out to you guys. And I'll try to respond. Like, obviously I'm going to respond fast depending on how fast you send it to me, right? But I'm going to just end the video right here. Hopefully this proper risk management video helps you on your trading journey, and feel free to just reach out to me on YouTube or reach out to me on Instagram if you want to get in contact with me. On that note, peace out.